Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate documents so you don't have to. Today we're diving into the world of venture capital loans with WTI Fund XI loans with WTI Fund XI Inc., a company whose name sounds like a character in a robot space opera. We will be checking out their annual report. Did they strike gold or are they just digging a deeper hole? Let's find out. This report is basically a snapshot of how WTI Fund XI did for the year ending December 31, 2024. They're a business development company, or BDC, which means they lend money to smaller companies hoping for big returns. They focus on venture-backed companies, those startups that have already gotten funding from venture capitalists. They give them loans, and sometimes they get warrants too, which are like options to buy stock in the company later. Think of it as betting on the future success of these startups. Because they are a BDC, they need to invest a large amount of their funds in qualifying assets, so they can't just sit on the cash. The goal is to keep their BDC status and make sure they are following the rules so things are constantly changing. They can invest up to 30% of their assets in non-qualifying investments, so not all of their eggs are in one basket, but most of them are qualifying investments. So not all of their eggs are in one basket, but most of them are qualifying investments. So not all of their eggs are in one basket, but most of them, so not all of their eggs are in one basket, but most of them are. They can also invest up to 20% in what they call special situation financings. These are basically riskier, more unique deals like lending to public companies or companies that are in a bit of trouble. It's like a high risk but have bigger payouts. Here's a weird tax thing. If the IRS doesn't consider WTI Fund XI to be actively running a business, the people who are members of the company might have to pay taxes on some of the fund's expenses, even if they didn't actually get that money. It's like being taxed on money you never saw, but the recent tax laws fixed the issue but will expire in a few years. Now, let's talk money. WTI Fund have a $250 million loan facility, a credit line they can draw from to make those loans to startups. Think of it as their start loan piggy bank. As of the end of 2024, they'd borrowed $21 million from it. They use the funds to fund other investments, and they pay the interest back later. Here's how the management team gets paid. They get a percentage of the total capital committed to the fund, not just the money that's been used. The management fee starts high and slowly goes down as the years progress. By year 9, they don't get a management fee, so there's a disincentive to stick around for the long term. With everything being digital, cybersecurity is a huge risk. If they or their companies get hacked, it could mean losing money, losing private information, and generally having a bad time. Cybersecurity is crucial for everything, so it is important to follow all the rules and keep everything running. A big risk is their investments depend on the manager making good decisions. What if the manager makes bad decisions? What happens if they leave? All of those things can affect how the fund does. There is one leader in charge of the decision making, and if they left it, can impact the fund's ability to function. Global conflicts cause global markets to be weird. War in Ukraine and Israel will affect a lot of different things in the global markets, domestic and credit markets, and will impact global economies. They may not be able to invest in companies involved in the conflicts, and the company operations will be negatively affected. A surprising risk factor is political because of US national security. There is a committee, the Committee on Foreign Investment in the United States, which can change international investment. This can block deals, force them to change the terms, or make the company and fund not make the investment. Most of the fund's investments are in securities that cannot be sold easily or fast. It takes a long time to convert the investments into liquid capital and collect on them. The company will need to wait for another company to purchase their investments or wait for the investments to become a public offering. Now let's move on to the real meat of the report, the financials. I'm scrolling through everything to get to the real stuff, or else we would be here all day. Here's the balance sheet, or a snapshot of what the company owns and owes. Their assets are $35.7 million from that big credit line. This means their assets outweigh their liabilities, which is good. Now let's check the profit and loss statement and see if they actually make income. They made $1.6 million in investment income, but they lost $5 million in expenses. This brings them to a net loss of around $3.5 million. In other words, they are spending more than they are making. Cash flow for operating activities, which is the actual amount of cash that's going in or out of the company based on loans, had a net cash used of around $31 million. So cash is going out of their operations more than cash is coming in. As for cash for financing, financing is positive with a roughly 40 million increase. The main reason cash is still high is from contributions from shareholders. They still have plenty of assets, but they need to become profitable to be worth investing in. This table talks about what happens to the income if there are interest rate changes. Interest rates going up is good. If interest rates drop 2%, they'd have an extra income of $230,000 or around $2 a share. On the other hand, interest rates are negative, so there's a lot more to interest rates going up. A reminder that risks is inherent with the fund. The fund is subject to risk based on a borrower's credit history, their underlying investor ability to sell with public offering. Let's check what the auditors Deloitte and Touche had to say about all this. The opinion is that they are presenting everything fairly in all material respects and in conformity with accounting principles. The auditors did have one critical matter to point out. Deloitte says that they took specific interest in the completeness of loans exhibiting potential credit deterioration. There is no public price for the loans, hence the fund determines their value and it is subject to high uncertainty in judgment. Basically, the audit focused on them being honest on how much their loans were worth. What does this all mean? A lot of debt and not a lot of profit. The fund relies on the manager to make great choices, keep the hackers away and operate internationally. The financial metrics show the fund has lost value for the year and heavily relies on continuous contributions to continue functioning. Let's check the numbers. A bad total return of 23%, a bad earnings per share of $729 and expense, ratio of 71%. For every dollar of assets, they are spending 71 cents on fees. It is not a great look. So what's my take? This fund is a high risk bet. It is relying on the manager, and for the startups to start succeeding, this is how most funds operate, but you should keep this in mind. Thanks for watching Corporate Decoder. If you found this video helpful, leave a like, comment, and subscribe.